Hello everyone, welcome. So we are going to discuss COSO framework today, and this framework is relevant to risk management. So it is also called Enterprise Risk Management (ERM) framework. Please remember this risk management. It has two main topics. In the first topic, last time we discussed what is risk management, and what is the process usually we follow to manage the risk. And then uh, 12.2 topic, this is second topic. Here we are going to talk about enterprise risk management framework. So this is very important chapter overall because you may have 10% of your exam questions from this topic, and this domain is called what? Risk management. So here we go. We are moving to the topic now, COSO framework. So, guys, first thing we need to understand what is the risk. We already discussed last time, but I'm just going to refresh the definition. We always say risk is unwanted event, like we don't want actually. Risk is unwanted event, okay, which can have negative effect on the organizational objective. And another way, for example, you may face exchange rate risk, how it may have negative effect on your business objective. So maybe you may suffer some financial losses. You may have compliance risk if you are not following laws and regulation. Obviously, again, it can affect you in terms of finance. For example, regulatory authorities, they can impose, obviously fine on you. So obviously, then why risk management is important? The only thing we need to manage the risk. The reason is that because if we will manage the risk, so we can save the organization from potential losses. So this loss could be financially also, like you may lose some money. This loss could be non-financial also, like maybe it may affect your operations also, or maybe it may affect your reputation also, right? So there are different risks. So this is what we are going to talk about. So our framework, which is COSO framework. COSO stand for Committee of Sponsoring Organization. So actually it is one of the important framework relevant to the risk. Okay. So here we go. We are starting with the ERM definition and concept first. Like what is the ERM definition, which is provided by COSO. So please remember, ERM is defined as, so what is ERM? Enterprise Risk Management. So actually, enterprise risk management is the culture. This is the first keyword. It is the culture. Second thing, it is the capabilities. Third thing, it is practices integrated with the strategy setting and performance. This is the fourth thing that organization rely on to manage risk in creating, preserving, and realizing value. So these are the keywords in the definition. So we need to understand these words first. So what is ERM? ERM is a culture, capabilities, and practices integrated with the strategy setting and performance. Okay. Why we need these things? Because we want simply to manage risk, to create value, to preserve value, and to realize value. So these are keywords. So starting first with the culture. What does mean by culture? First keyword I'm going to explain. So culture actually, guys, please, if you know, most of the organization, right, they are very risk conscious. You can say, or they are very formal in terms of risk management. And some companies, they might be informal in risk management. Formal risk management means that they have proper risk management department within the company. And this risk management department is properly overviewed by the, or reviewed by the, board of directors, like especially risk committee. And culture here, I'm explaining what, because organization culture, like as I gave you example of formal risk management. So actually, if you have a formal risk management, obviously it means you have a proper department. So if you have a proper department, so it means it will decide, it will set attitudes of the people, behaviors of the people, and understanding about risk. Okay, both positive and negative, that influence the decisions of management and personnel. and reflect the mission, vision, and core values of the organization. So this definition is obviously it seems very difficult, like how culture is defined. Actually, culture will shape the attitude of the people, behavior of the people, right? Attitude and behavior mean to say, guys, so like how we do the things, so it is always decided by our culture. Like simply, if top management, let's assume, because most of the time top management will set the tone at the top, right? So that tone will decide the attitude, behavior, and understanding about the risk. So culture mean to say, so we will set the attitudes of the people, behavior of the people, and understanding about risk. Okay. Understanding about risk. Okay. Why we need this? Because we need proper risk management. Okay. To take better decisions, to take better decision. Why better decisions are important? Because we want to achieve our mission, vision, core values of the organization. So here, word explaining now culture in more detail. So then we'll go through all these keywords here. So guys, why organization culture is important? Why like a tone at the top of the organization is important, or why it is important for the people? Okay, people's understanding about the risk, people's behaviors and attitudes towards the risk. Why it is important? Because simply we want to achieve our objective. So solid ERM. If you have a solid enterprise risk management framework, okay, so it can what? So a solid ERM framework and workplace culture create awareness of risk appetite. What is risk appetite? Risk appetite means is simply, so the top management will decide like how much risk we are willing to accept. For example, if you have money of $100,000 saving with you, or if, let's say if a company is having 100,000 saving with the company and they want to invest, so how much they, on how much amount they can take risk? Maybe they can risk of 200,000, 100,000, or maybe they can take a risk of 10,000. So this willingness, okay, willingness to accept the risk is called risk appetite. Understood? So culture will always create workplace awareness of risk appetite, and culture will also enable people to work within the set boundaries. Set boundaries mean to say like, which is also called core values. Core values means simply like which things are acceptable for the companies, which things are not acceptable for the companies, right? So in simple words, culture mean to say it is tone at the top, and that tone should be followed throughout the organization, right? And top management will set this tone, like, are they serious about the risk management? Are they not serious about the risk management, right? So their actions will decide, okay, the behavior, attitude of the people and understanding about the risk, right? Now your word is what? Why we need to set the attitude of the people, behavior of the people, and why we need to affect the understanding of the people about risk. The reason is that because we want to achieve what? Mission, vision. Okay. What is mission? So mission is the organization's core purpose. Like in simple words, whatever the current objective you are trying to achieve, that is called your mission. For example, if you are CMA students, so your mission is to, for example, pass CMA. So it may take a couple of months or years, right? So mission is always is the organization's core purpose, right? But vision is what? Vision is the organization's aspiration for what it intended to achieve over time. In simple words, vision means say where you want to be in the future. For example, being a student, okay, so maybe you want to be a CFO in the future. So right now to become a CFO, you need, let's assume, two things. You need experience and you need qualifications. Now, for example, you are working, you are gaining experience also, and you are doing, for example, studying professional qualification, you are gaining that one also. It means current mission is what? Maybe to achieve qualification, right? And if you will have a right qualification with the right experience in future, you will become CFO of the organization. And as I told you, core values. Core values are the organization's essential belief about what is acceptable and unacceptable. So simply we can say this is the code of ethics. Like organization will tell you like which things are allowed, which things are not allowed, or what you can do or what cannot you do, right? So this is what is called culture. So here keywords are what? Culture will always shape. Our culture consists of attitude, behavior, and understanding about risk, right? Because these things, attitude, behavior, and risk understanding will always influence the decision of management. right or wrong? And the decision of management will always affect your vision and mission, right? Maybe if management will take wrong decision, so maybe you may not achieve your mission or vision. Now here, guys, going more into detail, mission is what? Mission statement is a definition of company's business. Like simply, like what is our main company business? That is the mission. Okay. Who it serves, like to whom we are serving, what it does, what we do actually, and its objective, what is our objective, and its approach to reaching those objectives, like how you will reach or how you will achieve those objectives. So these things are always decided under mission. Mission is what? So what is the main company business, who it serves, what it does, what are the objectives of the company, and what is the approach to reaching those objectives. So these things are always decided by mission. So on the other hand, what is vision statement? Vision statement is a description of desired future state of the company, like where you want to be in the future, right? So obviously, if you have a bigger vision, obviously, guys, so you will work also bigger. So this is what they're saying. That is why an effective vision inspires the team, right? Like vision will decide the actions of the team also, showing them how success will look and feel in the future. So this is what is your vision and mission. So as I told you in the first uh, words in the risk management definition, that is culture, right? So I told you in culture, because when you are tackling the question, you need to work with these words. So culture means it is the attitude, behaviors, and understanding about risk, right or wrong, of obviously of organizational people, because these their attitude, their behavior, their understanding about risk will affect the decisions of the management, and decision of management will affect the mission, vision, and core values. Then, guys, we have here, second thing is what? Second word under the definition is the capabilities. As I told you, ERM is a culture, capabilities, practices. Okay, so second keyword is what? Capabilities. So what are the capabilities? Capabilities means capabilities are the skills simply needed to carry out the entity mission and vision. Like, do you have right capabilities, the right skill set, right or wrong to achieve the mission and vision? For example, if you have a risk management department in your company, but you don't have a right people, for example, to tackle finance risk, or you don't have a right people, for example, to tackle compliance risk, or you don't have a right people to tackle operational risk, it means risk management will fail, right? So capabilities means say we must have a right skill set which is needed to carry out the entity's mission and vision. So that is what capabilities. Capabilities is more about the skills. Then practices means say, obviously, if you have a risk management in department in your company, you have a culture also, like you have a tone at the top, like people are taking seriously the risk management. So you have capabilities also, but you are not utilizing those culture and capabilities to manage risk, right? So it means practice is more important. Practice is what? Practices are collective method used to manage risk. So now the point is that what does mean by here collective methods? Like how or which method you can apply to manage risk. So guys, to manage risk, what? So we can follow different methods. So these methods could be what? Actually, these are strategies. Like which strategies we can use to manage risk. So strategies can include what? Strategies can include what? Risk avoidance, risk retention, risk reduction, risk sharing, and risk exploitation. These strategies we already discussed in the last section, but I'm going to quickly repeat. Risk avoidance is the first method to manage the risk. Risk avoidance is what? For example, if you're doing any business, let's assume, and let's assume you are going to invest into the stock market, and there is a risk. Risk is that you may have loss, on your investment. So how you can avoid that risk? Simply stop the investment in the stock market. So it means risk avoidance means say ends the activity from which the risk arises. Simply you will cease that action where risk is arising. That is called risk avoidance. So then we have here what? Risk retention. Risk retention mean to say you are accepting the risk. For example, as I gave you example, let's assume you are going to invest in the stock. I'm giving you this opportunity to invest in the stock. Okay. So now I'm telling you, yes, there could be a loss also. This is risk is there. So risk retention means it is also called self-insurance. It is also called self-insurance. And what is risk retention? So you are ready to invest in the stock exchange. You are ready to accept, but you are not taking any strategy to reduce the risk. That is called retention. Retention means that you are accepting the risk, right? But you don't have any internal or external strategy to reduce the risk. That is called risk retention. So this is what they're saying, that then we have here what risk reduction. It is also called risk mitigation. This could be the third strategy. For example, again, I'm giving you option to invest into the stock market. And I told you there could be a risk of loss also. You are saying that, okay, so you are going to mitigate this risk. How? You are going to mitigate internally. You are not, engaging any external parties to mitigate it. So how you can internally mitigate? It means here you are accepting the risk first, then you are trying to mitigate also. How? So you are saying that, okay, how you can mitigate this risk? So you should not, or I will not, for example, invest the whole amount of my saving into one company's stock, right? So I will diversify my investment, right? So diversify means that some money you will invest in company A, some you will invest in company B, and some you will invest in the company C stocks. Because, for example, if you have a loss on company A, maybe you may have a profit on company B or C. So loss on one side can be compensated with the gain on other side. So this is what is called risk reduction. So risk reduction is the act of lowering the level of risk associated with the activity. Understood? For example, if you have another example, for example, if you have a risk that your system might be hacked, okay, information system might be hacked. So how you can reduce it? So you can reduce it by having robust information security function, or you may reduce it by installing firewall system, antivirus system, etc., which can reduce your risk. This is what is called risk reduction. And the fourth collective method which we can use, that is called risk sharing. Risk sharing means it is like an insurance. Please remember, under risk retention, I use the word self-insurance. Here, I'm using the word insurance. So risk sharing means simply you are going to transfer some loss potential to the other party. For example, as we do in in buying of car, let's say if you bought a car, so what you will do, you will get the insurance of car, right? Reason, because you want to transfer your risk, okay, to the insurance company. So, but you have to pay premium for that, right? So it means cost is there, benefit is there. So risk sharing means what? Simply you are going to transfer some loss potential to another party. Okay, this is what is called risk sharing. Then we have a risk exploitation. Actually, this exploitation or this method is mostly applied by gamblers or those companies which are having, high risk appetite, high willingness to accept the risk. For example, gamblers, they always look for risk and return relationship, right or wrong. If they feel this investment can give you high return, obviously there would be a high risk attached with that investment, right? So gamblers will always look where is high risk, because high risky investments will give you high returns. For example, if you're investing in the stock of the company and you are gambler, or you just want to earn money in the short term, so you will never select a company whose stock price is stable. No, because there you will not get opportunity to make money. So you will always select a high risky company whose stock prices are volatile, are fluctuating, because there you can get the opportunity to make profit, right? This is what is called a risk exploitation. So this is what the three words I have explained. Okay. So the first thing I told you, what if you will move to the definition. So risk is a culture. As I told you, culture will always define behavior, attitude, and understanding of the risk. Okay. Of the employees of the business, because they are taking decisions and their decision will affect mission, vision, right? And core values. And then I told you capabilities. Capability means that we must have a right skill set to manage the risk. Okay, and then we have to apply practices. Practices means a collective method, like which method we can use to manage the risk. So those methods I have already explained, like you can use maybe risk retention, risk reduction, which is called risk mitigation, also risk sharing, or risk avoidance, risk exploitation. Now I'm going to tell you here the fourth component of definition, which is called integrated with strategy setting and performance. This is the fourth thing I'm going to explain from the definition. Okay, guys, please remember here we have to understand your word first. What is strategy? Okay, and performance, and then we will go through what does mean by integration. So please remember here, guys. So whenever you are setting any plan, strategy means the plan. Okay, it is a plan like to achieve your objective, right? So whenever you are setting any strategy, right? So you need to consider first risk associated with that strategy. Like how many risks are there, or which kind of risk can arise due to this strategy, due to this plan, right? So that is why it's important. What is important, that risk must be considered in setting strategy. Whenever you're setting strategy, you have to consider risk. Okay. And even when you are setting business objectives, you need to consider the risk also, like which risks are there. And even when you are setting performance targets, you need to also consider targets. I hope so you understand performance targets, right? So even when you are setting targets for certain departments, you also need to consider what is the risk at there, right? And you also need to consider how much risk you can tolerate. So in simple words, so whenever you're making any plan, or you are setting any objective, or you are setting any performance target, so you have to consider risk. For example, you are professional students, okay? You are making strategy for your study, right? So there are risks are there, right? Uh, God forbid, I'm just using the word risk. So what kind of risks are there? Maybe in emergency, you may have to travel to your home country. You may not be this, you may not stick to your plan, right? So this is possibility, right? So there are risks, are so many risks are there. Okay, now here, first what it is explained, what does mean by strategy, and then I'll tell you how integration is done. So strategy, I'm explaining what. Strategy means what? Strategy communicates how the organization will achieve its mission and vision. Simply, it is plan, right? It is plan, like how you will accomplish your mission and vision. Okay, and apply its core values. Again, what is core value means? Say the acceptable and unacceptable things, right? So obviously you will apply your core values. Okay, like core values means it's a code of ethics. Obviously, you are guiding always your management, like what is acceptable, what is not acceptable. So only acceptable things they have to do, right? So strategy simply communicates how organization will achieve its mission and vision and apply its core value, right? So then here we have second thing, business objectives are steps. Whenever the word you see business objective, objectives are the steps taken to achieve the strategy. Like what steps you have to take to achieve that strategy. That is called what? Business objective. Obviously, if you will, uh, you know, uh, achieve small objective, let's assume your strategy, I'm just assuming. For example, your mission is what to do CMA, let's assume. Okay, this mission can be broken down into series of objective. Objective is what? First, you have to pass part one, then you have to pass two. And how you will pass part one or part two again? This objective requires planning again, right or wrong. If you will achieve this plan, you will pass part one. If you will achieve this plan, you will maybe pass part two, and one day you will accomplish your mission, and then you can also accomplish your vision to become by becoming a CFO. This is what is called business objectives. Then, guys, here the keywords here. So they're saying whenever you are setting any strategy, you have to integrate risk with the strategy. You need to you need to create risk profile for each strategy, okay, or for each unit or for each department. So now I'm going to explain here what does mean by risk profile. Okay, what does mean by risk profile? Risk profile means say you can say it is simply a composite view. Composite means say you can say it is like a document. You can assume it's a document in which three things will be written. What? Like for example, due to this strategy, which types of risk you are facing, how severe those risks are, and what are the interdependence of the risk. Interdependence, like for example, if you're making any plans, you have to think first thing, due to this plan, which types of risk you are facing. Second thing, you need to think how severe those risks are there. And third thing, you have to see interdependence of risk. Interdependence of risk is what? Like maybe one risk can lead to another risk. That is called interdependence risk. Right or wrong? So for example, there could be a, let's assume, I'm assuming, giving example. For example, if there is a new technology, so risk is that maybe if there is a new laws and regulation, what is risk? The risk is that, okay, maybe there could be a non-compliance, and this non-compliance can lead to another risk, what that is financial losses. Both losses are there, reputational and financial losses. So this is what is called interdependence of risk. So what is risk profile? Risk profile is the composite view, or you can say it's a documents, which will include type, severity, and interdependence of the risk, right? And you will also see what are the effect of those risks on your performance. on your performance. This is what is called risk profile. Okay, so this risk profile or this document you can create even at entity level, or you can create at even at divisional level, or you can create even at a factory level, or you can create even at departmental level, right or wrong? Or maybe you can create this risk profile regarding some product, or regarding some services, or you can also create this risk profile geographical area wise also. Okay, this is what is called your. It's clear, guys? So this is what does mean by integration. Integration means whenever you are setting the strategy, you need, I'm just revising in simple line. Whenever you are setting any strategy or any performance targets, you need to consider which kind of risk you can face from due to this strategy. Kind of risk means types of risk, how severe they are, right? And what are their interdependence, right? So you have to think, right? This is what is called integrating strategy, setting, and performance. And usually when you think about types of the risk from the strategy, or severity of the risk, or interdependence of the risk, so that is called what? Risk profile. Okay. And risk profile is a composite view. Composite view means you can say you can create even at entity level, divisional level, unit level, departmental level, at product level, at service level, or at geographical level. Then guys, we have here, there is one more word that is called portfolio view. Portfolio view. Portfolio view, because sometimes they ask the difference, right? Portfolio view is the similar to risk profile. Risk profile, you remember three things we record: types of risk, severity of risk, and what? Interdependence of the risk. So risk portfolio view is what? So the difference is that it is also composite view of risk related to entity-wide strategy and business objective, and their effect on entity performance. So it means in risk, it is risk profile, but portfolio, when we say it is a portfolio view means you are here, you are looking risk at entity level, or you are looking risk associated with the entity level strategy, not at divisional level. For example, Pepsi company, let's assume. So they have, operating units in different countries. So here you are not thinking only at country specific level. No, you are thinking at entity level. So here it is a risk profile, similar to risk profile, but here the difference is that it is a composite view of the risk related to entity-wide strategies and entity-wide objective, right? And entity-wide effect on performance. So this is what is called portfolio view. Then here, guys, next keyword in the definition, if you will go, because this is what various words are there. I told you about these things. If you will just remember, I told you what? I told you ERM, Enterprise Risk Management. It is a culture word I have explained. It is capabilities means skills, practices, and integrated with the strategy setting and performance. Now, keyword is here that organization rely on to risk management, because organization has to rely on risk management, right? To create, preserve, and realize value. So this word I'm going to explain now, risk management. By the way, for risk management, we have a proper department there, proper steps are there. But here we are supposed to discuss under ERM. We are supposed to discuss different words under risk management. Like obviously to understand the risk management, so we need to understand different words. So that is why first word as a vocabulary it is written. So risk is what? Risk is the possibility that event will occur and it affect the achievement of strategy and business objective. Like simply, it is any unwanted event which can affect our organizational objectives in negative way. Then we have a risk inventory. It's another word. Risk inventory consists of all identified risks that affect strategy and business objective. What it means? Actually, it is the list of all identified risk, whatever. Because it being in your department, risk management departments, they're creating certain documents, right? So they may create risk register also, right? You may have some software also in which you are recording all your identified risk, okay, that can affect your strategy and business objective. So that list of identified risk, okay, is called what? Risk inventory. Then we have here what? Risk capacity. Risk capacity, I told you previously, risk appetite, right? Risk capacity is the what? Is the maximum amount of risk that organization can assume. Like how much maximum risk you can take. That is called what? Risk capacity. Then what is the risk appetite? Risk appetite mean to say like how much amount and type of risk you are willing to accept. Like for example, maybe you have you can take, maybe you can gamble on $1 billion, but right now you can take risk only up to $1 million. So it means capacity was maybe 1 billion, but how much risk you are willing to accept, that is 1 billion. This is called what? Risk appetite. Understood? Then what we have here? Then we have other words actually under risk management terminologies. We have here actual residual risk. What is residual risk? First, let me tell you. Residual risk means, when you apply a risk management strategy like risk avoidance, risk retention, or risk mitigation, or risk transfer, whatever risk is remaining after taking those strategy, after adopting those strategies, that is called residual risk. Okay. So what is actual residual risk? Actual residual risk means say this is the actual risk which is left after implementing the strategy. Then we have here, guys, another word, a target residual risk. Target residual risk means what? Like when you apply a strategy, before applying the strategy, you may think that if you will follow this, for example, risk avoidance strategy or risk mitigation strategy, so this is what is the expected remaining risk. So that is target. What actually is remaining, that is called as an actual residual risk. Then we have another word which is called inherent risk. Inherent risk is the risk in absence of management action. Like if you do not have any control, okay, to alter the severity of the risk, that is called what? Inherent risk. Understood? So inherent risk is what? Inherent risk mean to say what risk you are facing in the absence of management control. Because if management will not place the controls, so it cannot alter the severity or impact of risk, right? So whatever built-in risk in absence of management control, that is called residual inherent risk, sir. Then risk response, I already told you, these are collective methods which we apply to mitigate the risk, okay, or to reduce the risk. So risk responses may include, as I told you, risk avoidance, risk mitigation, risk retention, and risk sharing, risk exploitation. Then guys, here I told you this point at the start because now we are talking about ERM roles and responsibilities. Okay, roles and responsibilities. So who is responsible? Actually, management has overall responsibilities for day-to-day operations. Obviously, if they have overall responsibility for day-to-day operations, so they are also responsible to manage the day-to-day risk also. And they are also responsible to implement and development of COSO framework also. So management means a CEO. CEO is ultimately responsible to manage the risk, right? But CEO is not alone. Obviously, risk management department is also, oversee by a risk committee. Do you remember under governance we studied like under the board of directors as per US corporate governance? So there must be three committees, minimum three committees must be there. One is called audit committee. So audit committee usually deals with audit kind of issues, internal and external audit. Risk committee should be there. Risk committee is responsible to oversee actually the risk management, right? And then we have a executive compensation committee. Usually this committee set the salaries for the board of directors. So point is here. So 2 points you have to remember. Actually CEO, for CEO we can use the word management also. Management is responsible for day-to-day risk management, but so the risk management must be overseen by a risk committee. Risk committee means a board of directors because risk committee is a part of board of directors. And then sometimes, guys, we have, risk officers also. You may risk officer means it is like a coordinator, you can say, right? So who can take instructions from maybe top management or maybe the board of directors, and he may also pass those instructions to the management, means the departmental managers who are responsible to manage the risk, right? So that is why organization may designate. It is the word may, so maybe you can designate our risk officer as a centralized coordinating point, okay, to facilitate risk management across the enterprise, entire enterprise. Okay, so here we go. Then guys, there is a one more small thing is there. We have a three lines of management accountability, and we can say these are the three lines for risk management also. Like for example, whenever you are trying to manage risk, so you have a three layers, okay, to deal with the risk. First layer is what? First layer is called principal owners. Principal owner means a departmental managers. For example, if risk is under operation department, first operational manager he is responsible to identify that risk and to manage that risk, right? Okay. And for example, if risk is related to exchange rate, which should be the responsibility of, let's assume, finance people. So finance manager could be the principal owner. He is responsible to identify the risk from the day-to-day activities and to manage them, right? So that is called principal owner. So this is the first line of defense. The second line of defense is called what? Business enabling function. Business enabling function means that these are the risk officers. Okay, like example, risk officers. So what they do now, here is the role of risk officers are explained. Okay, this is the second line of defense, right? So what risk officers they will do? So they can provide guidance on performance and ERM requirements, like how to perform enterprise risk management or how to manage risk. So guidance can be provided by risk officer. Second thing is what? He may evaluate adherence to the standards. He may check that principal owners are following the guidelines which are provided by risk officers or by top management. And he may also check what? He may challenge the first line to take prudent risk, right? Like, for example, what actions the first line of the departmental managers has taken, he can challenge those actions also, right? So this is what these are the functions of risk officers. It means risk officers, what he will do, he can provide guidance on performance of ERM, he can evaluate adherence to the standard, and he can challenge the first line, okay, of the defense, their actions. Then guys, third what we have here? Third line we have here. Third line. Third line usually what? Third lines are assurance providers. So usually these are internal auditors. It could be external auditor also, because when the external auditors they do the audit, they also check internal controls, okay, related to, but they are primarily responsible for finance related internal controls, right? So, but here let's you take the example of internal auditing. So this is the third line. Internal auditors, what they do? So they will come, they will do certain audits. Maybe they can do the audit of risk management department also. They can do the audit of operations, compliance, right? So they will review ERM. They will first thing, they will audit the ERM, review the ERM. They will identify the issues. They will identify the issues. What are issues in our risk management? And they may also recommend some improvements. This is their role. And they may also, obviously, internal auditing department, they will report back to the audit committee, directors, right? For those matters which need resolutions or need attention. So this what is the role of internal auditors. Okay, guys. So this is what is so far we discussed about definitions mainly and certain things inside. Now we are moving to the ERM components. Okay, COSO components. It is also called ERM 5 interrelated components. 5 components means say you can assume these are 5 pillars of risk management, of enterprise risk management framework. Okay. And in these 5 components, we have 20 principles. Like in simple words, if you want to have effective risk management, so you must have 5 things. And under those 5 things, you have to follow 20 principles. Okay. So that is called what? ERM component. So here we go. First component is called, please, I'm just reading the name here. First component is called what? Governance and culture. Second is called what? Strategy and objective setting. Third component is called performance. Fourth is called review and revision. And fifth is called what? Information, communication, and reporting. Please remember these three. These three are called common process. Common process. Okay. This is very common in all organization. Okay. And these two, the last one and the first one, the blue color is called what? Sporting aspect, sporting process. So here, these principles are written in a shortcut here. Okay, as a headings. So I just want to explain these things. So first of all, I'm going to explain governance and culture, because whenever you want to revise this topic, okay, if you do not want to read the full detail, then you can have a look to this picture. At least these principles you have to keep in your mind. The reason is that in exam question, they may ask you which principle fall under which component. Okay, so but I'll explain all things. So here we go. First of all, governance and culture. Culture I already explained to you at the start also, because culture consists of attitude, behavior, and understanding about the risk, right or wrong. Because these things will reflect on your decision making, on the management decision making, and management decisions will affect the achievement of mission, vision, and core values. So this is what they're saying. This is the same thing is written here. They're saying cultures relate to the desired behavior, values, like what we expect from the people, which kind of behavior, values, okay, and overall understanding about risk held by personnel within the organization. So the point is, who will create governance and culture? I told you already, governance and culture is always set by top management. Our tone is always set at the top. Tone is always set at the top. But to set that tone, so we have to follow five principles, these five principles. These five principles we need to follow. One, two, three, four, five. And these five principles are written there. Okay, you have to remember these principles, please. So first principle is what? How tone can be set at the top. The first of all, the first point they are saying the board exercise risk oversight. Yes, it is true, and we know there is a risk committee who will always oversee the risk activities of risk management department. So first of all, it means in simple words, to set the governance and culture, we need to do five things. First thing is what? The board must exercise the risk oversight. Right or wrong? So the risk oversight should not be under management only. No, because management is responsible for day-to-day management of risk, for the day-to-day management of risk, but board must oversee what they are doing. And usually how board oversee the risk activities of risk management? Board always use internal auditors. So internal auditors will go there, they will do the audit, they will I'll highlight the issues, they will provide recommendations, and they will report it back to the board of directors. This is how board can exercise oversight role. So first, to develop corporate governance and culture, the board must exercise risk oversight. Second is what? Second, this is the first principle. This is second principle under governance and culture. Second principle is what? The organization established operating structure. Organization establish operating structure. What it means? Operating structure, guys, there are two types of structures are there. One is called legal structure, second is called management structure. So what we need to establish? Operating structure. So guys, legal structure is what you have to define first. Are you a single entity company, or you are running multiple entities, right? So this is what is called legal structure. So legal structure determines how the entity operates. Are the single entity, are there multiple entities? Okay, entity means a company. There's one company or more than one company. But operating, what is management structure? Management structure that you also need to be defined. Management structure means a reporting line, simply reporting lines, like who will report to whom. For example, who is senior, who is junior, or who is manager, or who is CEO, or who is, for example, board of directors. So this is, there is always a hierarchy is there. So that is called management structure. So management structure always established reporting lines. Okay. So these two things should be done. First thing is what? The board must take his responsibility to oversight the risk management department. Second thing, the organization establish operating structure. Like there must be a structure hierarchy of the organization, which and it may be there are two types of structure. Mainly our focus is on management structure, right? But legal structure is also word is there. Then third thing, what we need to do, the organization defines the desired culture. Desired culture, I already told you, like what is culture? Like which kind of behaviors you are expecting from the people, desired behavior. Which kind of attitude you are expecting from the people, desired attitude, right? And you also want the people to know about the risk management, right? Because these things are going to affect their, obviously, objectives, right? So, or affect their management decision. So this is the third thing, culture must be defined. And obviously, guys, whenever you are defining the desired culture, you need to consider internal factors also, external factors also, right? You cannot make culture anti-law, right? Or anti-regulation. So that is why internal factors are what? So you have to think, okay, like for example, internal factor include the level of judgment and autonomy allowed to people, like what are their authorities. For example, you are giving authority to one person that he can take all investment decisions. So These are called autonomy. So you have to see like level of judgment, which kind of judgment you can use. Autonomy allowed to the people. What are the standard and rules and reward system in place? You have to check these things like what are procedures in place. Okay, what is there any reward system is in place? So these things will define the culture. Okay, for example, if people are doing good, you may reward them. And if they are doing bad, you may punish them also, right? So these are internal factors which will decide the desired culture. And external factors are what? So legal requirement. Obviously, when you are defining culture or desired culture, you need to consider what are the legal requirements. You also need to consider what are the expectation of stakeholders, like what investors they want from you, what customers they want from you, what government they want from you, right? So this is what third thing you need to define. The first thing was what? I'm talking about first thing, guys. Governance and culture, the first component. And there we have a five principle. Principle number one is what? Board must exercise oversight role. Principle number two, what? Operating structure must be established. Principle number three is what? Organization must define the desired culture also. And principle number four is what? The organization demonstrate commitment to core values. Like whatever you have a code of ethics, like list of do's and don'ts. So whatever is acceptable or unacceptable. So the organization has to show commitment to core values. Okay, you have to be stick with the code of ethics. And the fifth point is what? Organization attracts, develop, and retain capable people. This is the fifth point. Like, for example, it should not be like that you are hiring capable people, competent people, you are not, maybe developing them for their career, or maybe you are not retaining them. So you should hire, uh, you know, competent people. Okay, you should develop them, like career succession planning should be there, and you should retain that. If you will have these five things, then we can say there is a governance and culture. Now I'm going to show you these five things in short, because I told you you can memorize, revise from here also. First thing is what? First principle under governance and structure is what? Exercise board, exercise board risk oversight, exercises board risk oversight, establishing operating structure, define desired culture, demonstrate commitment to core values, attract, develop, and retain capable individuals. These are five principles. If you will do these things, it means governance is there, culture is there. Second is what? Second, guys, we have here strategy and objective setting. Okay, strategy and objective setting. So there are four principles inside. So strategy and objective setting, let me take you there now and let me explain those four principles. Okay. Do you remember I told you about integration of strategy setting and performance, right? So it's the same story here. So what we have here, obviously, we will always set strategy, and strategy obviously should support the organization mission, vision, and core values. So integration of ERM. Integration of ERM with strategy means whenever you are setting any strategy, you need to create a risk profile. I told you, right? Risk profile with each strategy. Risk profile can be created even at entity level, at unit level, okay, even for specific strategy or for specific product or for specific service. So the point is, so you need to consider due to this strategy, which types of risk you will face. The risk file will decide these things. Which types of risk you may face, how severe they are, and what are their interdependence. So this is what is called strategy and objective setting. Okay, to integrate risk management with the strategy and objective setting, we need to follow four principles. And these four principles you need to understand. First of all, they're saying the organization analyze. This is the first principle. First principle for strategy and objective setting. The organization analyze business context. Organization analyze business context. Okay, and its effect on risk profile. Business context, guys, like simply you have to decide in which area or which things can lead to the risk. For example, maybe you are business context could be maybe the relationships, like relationship with the customers, with suppliers. You have to look which kind of risks are there. Our business context could be certain events, certain transactions. It could be certain trends, or it could be any other factors, right or wrong. So this is what they're saying, that business, you have to see like uh, you have to analyze actually business context, like where you are facing risk. Maybe you are facing risk under relationship with the stakeholders, or with certain events, or within certain trends, or with certain factors. And then you also need to consider what is the effect, okay, on the risk profile. Like due to this context, how your risk profile will change, like types of risk will change, how severe they are, and how much interdependence they have. Okay, this is what is called first principle, business context. Then guys, we have a second principle. Second principle is what the organization defines risk appetite. First, you have to look, you have to analyze business context and effect on risk profile. Second is what you have to define risk appetite. Risk appetite, I already told you. So simply the amount of risk that we are willing to accept in pursuit of value. Like how much risk you are willing to take, that is called risk appetite. Right or wrong? And obviously when you are setting risk appetite, right or wrong, uh, obviously risk appetite cannot be more than risk capacity, right or wrong? Usually capacity is bigger. Risk capacity, I told you, the maximum risk which we can assume. And appetite means how much you are willing to accept. Usually risk appetite is less than risk capacity. Right or wrong? So risk appetite may be expressed qualitatively. For example, maybe you want to accept low risk only, moderate risk, or high risk, or quantitatively also maybe in percentage of financial amounts. So maybe you can take risk up to 100,000, 200,000, 1 million, $1 billion. So that is why risk appetite can be expressed qualitatively also, quantitative also, right? Appetite means how much risk you are willing to take. This is the second principle. Third principle is what? Third principle is what? First principle was what, guys? For strategy and objective set, the first principle was what? We have to analyze business context and effects on risk profile. Second was what? You need to define risk appetite, right? And third, I'm going to explain. Third is what? The organization evaluates alternative strategies and their effect on risk profile. You know, sometime you want to achieve mission. Okay, to achieve this mission, maybe you have plan A, plan B also. Right or wrong, you need to consider each plan. And for each plan or for each strategy, you can create a separate risk profile. Again, like here in this plan, which kind types of risk you are facing, how much they are severe, and what are their interdependence. And for this plan, which you can again create risk profile, like which types of risk you are facing, how severe they are, and what are their interdependence. So this is what they are saying. Organization evaluate alternative strategies and their effect on risk profile. And obviously, when you evaluate alternative strategy, you can use SWOT analysis also, maybe past analysis, different analysis you can use, but you have to be strict here with the principle. Then principle number 4 is what? This is the fourth and last principle for objective setting. Okay. The fourth principle is that the organization establish business objectives. Obviously, will set business objectives. And those objectives must be aligned with strategy. Like objective should support strategy. This is what they're saying. Like set the objective which are aligned with the strategy. These four principles are there. And now I'm going to explain. Just going to show you picture. These four principles are written here in shortcut. Strategy and objective setting. What is the first? Analyze business context, define risk appetite, evaluate alternative strategies, and formulate business objectives that are aligned with the strategy. Then we have here performance. Performance means simply you should have risk management. You should have risk management department like that. Okay. And there what you will do, I can explain from here also. So there are five principles that are there under performance. Okay. Number one, identify risk, assess severity of risk, prioritize risk, implement risk response, develop portfolio. So I'm going to explain these now. In performance, guys, please, first principle is what? There are total five principles. So first principle is what? This is the first principle. The organization identifies risk. Like simply first you have to identify the risk. Okay, which may affect the strategy or business objective. Right or wrong? This is what is called first principle. Like identify the risk. Risk could be new, emerging, or maybe there are environment or conditions are changing. For example, maybe you're shifting from maybe physical business to online business. So changing risks are also there. Okay, new emerging risk can also be there. Okay. And then when you, this first is because when you identify risk, I told you previously, guys, in the first lecture of the risk management, like there are different methods to identify risk. We can use questionnaire, facilitated workshop, interviews, day-to-day activities. We can review data tracking. We can use brainstorming, these kind of things. These terminologies I have explained there. Okay. So this is first thing, like simply you have to identify the risk. Second thing is what? This is second principle. So we need to assess the risk. It is also called risk assessment. And obviously risk assessment is also explained in the first part. Okay. In the first lecture of this unit. So there I told you whenever you assess the risk, you take for each identified risk, you always check two things. Which two things you check? You check what are likelihood of that risk and what are impact of that risk. Likelihood means how much chances are there that this risk will arise, which is also called probability. Impact means how severe it is. So for each risk, you will check. Obviously, if the risk is high likely and impact is critical, maybe you will prioritize, right? If risk is less likely or less chances are there, impact is minor, maybe you will not prioritize, right? So that is why you will always check, or you will always measure, or you will always assess the risk, right? In terms of impact and likelihood. Impact, I told you, impact is the result or effect of the risk. What will be the effect of risk? Impact could be positive or negative both. Likelihood means simply possibility, chances of occurrence that this event will arise. Understood? So it is also called probability. Okay. So then guys, risk assessment can be at multiple levels. Maybe you can assess the risk at entity level, at division level, or even at factory level or departmental level. Okay, and please remember risk assessment could be qualitative and quantitative. So these terms I have already explained in the first session. Quantitative risk means maybe you're using certain formulas or some certain simulations, okay, to quantify the risk, quantify the amount of risk. And qualitative means maybe you are using your judgments, like these benchmarking, okay, or surveys or interviews to assess the risk. That is called qualitative. So these things I have already explained, but here the main point is the first thing was you have to first principle under performance is first principle is what you have to identify risk. Second principle is what you have to assess the risk assessment. This is second thing. And third principle is risk modeling. Risk modeling actually is the method of risk assessment and prioritization. For example, so here you have risk modeling. This is how risk modeling we can do, or we can prioritize risk modeling. We are doing third principle. Okay. For example, let's say on one side, you can write impact. Impact would be critical, major, minor. Likely means the chances. Let's assume chances are remote, means a very less chances. Possible, maybe let's assume 50-50. Likely means more chances are there. Okay. So here, for example, we have a one risk. It is classed, it is categorized here. It means what? Chances are remote, impact is critical. Risk B, chances are possible, impact is critical. Risk C is here, chances are possible and impact is minor. Risk D, chances are likely, impact is major. Now, being a student or being a management, which risk you will prioritize first? Prioritize means say which risk you have to manage first. Actually, it depends. It's totally judgmental. Maybe I'll consider this risk first. It is my observation. Maybe I'll consider first this one. Which one? This risk B. Why B? Because chances are possible, impact is critical, big impact it has. So maybe I'll consider first this. Oh, I should manage this first. Maybe you may consider this risk D because chances are likely, high chances are there, and impact is also major. It is totally subjective, guys. But this is what is called risk modeling. It is also called risk map. Understood? Then when I say subjective, means it is totally your judgment, which risk you want to categorize first. Then guys, fourth principle is what? Fourth principle is that, so you have to select risk responses. Risk responses, I have already told you previously, even in today's session. Like we have a different responses or different collective methods we can use to mitigate risk or to reduce risk. We can have risk retention, acceptance, risk avoidance, risk pursuit, risk mitigation, risk sharing. Okay. So acceptance or retention. Here I told you previously because here they use slightly different words here also. So risk acceptance and retention means say, which I told you self-insurance previously, that you are accepting the risk, but you don't have any strategy to reduce it. That is acceptance. Avoidance simply means say that wherever you face risk, simply you are going to seize that action. Pursuit means say like it's a exploitation. Risk reduction mitigation means say you are accepting the risk, but you are taking strategy to reduce it. But usually these strategies are internal strategy. Then we have here what sharing means is simply insurance. Like you are going to transfer the risk. There's sometimes words they use different guys. You should remember these points. So these are four principles. Let me see if there is any fifth principle. Uh, okay, so there are side another thing that I'll tell you at the end, but let's go back to the main picture. So here we have a main picture, guys. So we have a performance means say identify risk, assess risk, prioritize risk, implement risk response. Then here we have a develop portfolio view. This is the fifth principle here that I have to explain. Here is the fifth principle, guys. So develop and evaluate portfolio view of the risk. What does mean by portfolio view? Portfolio means that you have to actually see how you are identifying risk, assessing risk, prioritizing risk, and responding to the risk, right? You in using portfolio view risk management determines whether entity's residual risk profile, like how much risk is left. Okay, we have to look like how you are trying to reduce it and how much risk is left, and whatever if risk is left, is it within risk appetite or not, right? Or this is what you can go through proper statement using portfolio view of risk. Management determines whether the entity's residual risk our risk profile inclusive of risk response aligns with the overall risk appetite or not. Like whatever risk responses you are applying, so those are aligned with appetite. Appetite means those responses bring the risk within your willingness, within your, you know, willingness to accept the risk, or it is beyond that, right? This is what is called portfolio view of risk. And then guys here, the fifth scenario that is called what? Review and revision. Review and revision. Review and it's, I believe, fourth component. If you will go back. So this is what review and revision. So why guys, what it is here? Review and revision. So here, review and revision means simply organization reviews. Here, what you will review and revise its current ERM capabilities. Capability means skills and practices. Like you have to check, do you have right skills to manage risk? Are you applying, you know, right collective methods to mitigate or to manage the risk? This is what is called capabilities and practice. You have to review and revise based on changes in strategy and business objective. Sometimes your plans are changing, your objectives are changing. Based on that, you need to review your current ERM and you need to check, do we need new capabilities and new practices to manage those risks or not? That is what is called review and revision. So for that, we have three principles. First of all, assess substantial changes. Like what are changes are there? For example, in COVID-19, most of the businesses are shifted from shops to the online business, right? So you have to assess what substantial changes are there. Then you need to review risk and performance, like which kind of new risk you are facing due to these changes. And you also need to check are your existing ERM is responding to those risks or not. And then third, if your existing ERM is not responding to those risks, then you need to bring some improvements in your risk management. This is what is the three principle under review and revision. Then we have here information, communication, and reporting. So here, guys, what you have to see, what does mean by information, communication, and reporting? So they are saying the organization must capture, process, and manage and communicate timely and relevant information. For example, if there is any new risk, or for example, let's assume there is a risk in operation, or maybe there is a risk of the compliance, or maybe there is a risk of exchange rate, or maybe there is a political risk. So you have to capture the information on timely basis, and then you need to report. You need to inform the relevant people on timely basis, right or wrong? Okay, because it will affect your strategy and business objective also. If you will delay, maybe you may face certain losses. So there are three principles we can follow. First thing, they are saying that leverage information and technology. Like we can use proper softwares, proper system, right, to capture and process the information. Second is what? Communicate risk information. As I told you, whenever you will capture the information, okay, you should communicate immediately to the relevant people, right? And then third, reports on risk culture and performance. You can do the reporting internally also and externally also, right? Internally means say you can report to the board, okay, and externally means say maybe you can report to the stakeholders. So these are five components and their principles. Okay, guys. So five components have 20 principles. So what I suggest you to remember these components first and inside their principles. Mainly, sometimes they ask the question, which principle falls under which components. Okay, guys. Now, guys, we are going to discuss about ERM limitations. Sometimes they ask the questions about this. So these are mainly limitations of ERM. Like you can say problems with the ERM. So ERM results from like you cannot sometimes get the desired results by having enterprise risk management. The reason, first reason could be a faulty human judgment. Like what it means, like human judgment can be defective. You know, sometimes we assess the things in wrong way. Maybe you may have wrong identification of risk, or maybe you may have wrong risk assessment. So this, due to that, you cannot produce the desired result. So there is another thing, cost benefit consideration is also important. So this is also limitation. Sometime maybe you are devoting much time to manage risk, but the benefit of that management is not enough. The benefit of that risk management is not justifying your efforts, right? This is what cost benefit consideration. Sometimes we make errors. For example, breakdowns and failure occur as long as people are those who are operating internal control system. This can include basic error, like simple errors and mistake means sometimes we design the controls. Those controls could be insufficient, or those control might not be appropriate for that risk. Sometimes we have a collusion. Collusion is what? Sometimes, for example, maybe I'm saying that A solution is better, you are saying that solution B is better. So we may collude on this. This is what is called collusion. And management override of ERM practices also. Sometimes management, they don't follow intentionally the practices of ERM. This could be the limitation. Due to these limitations, maybe you will not get the desired result. Okay, guys. So this is what ERM limitations. This is theory, and mainly here you have to memorize these points also. So thank you so much, guys.